We often talk about institutional adoption in crypto. Well, that requires some of the largest institutional players to come in and create products that are similar to what we have in legacy markets. And there's no company bigger or better to do that than the S&P. Chuck Mounts and Charles Jansen came together. They're unlikely teammates to form the DeFi team at S&P, and they're going to create indexes and ratings just like we have in legacy markets for crypto. It's absolutely huge, and you don't want to miss their story. I would have loved to have been a fly on the wall.
Right.
At the conversation where you pitched this to the CEO.
So they were actually separate conversations and many.
And you got the maple, the centrifuge, the TrueFi, the goldfinch, the clear pool.
People think bipartisanship is dead in the US.
You actually just identified the truth, and people don't want to hear it.
Stablecoin risk,
Corporate risk assessment,
governance risk,
sovereign risk assessment,
liquidity pool risk,
structured products risk assessment,
protocol risk.
I'll take it.
deep pool of credit expertise.
So if you guys can help us open those floodgates, we really appreciate it. And we'll be cheering for everything you guys are doing.
That's dope.
I can say personally that the first thing I think of when I hear S&P is cryptocurrency. Obviously not the case, right? So I would say that might actually be the last thing that you would think about. So how is the S&P now involved in this space, and why?
Right. So S&P Global has multiple businesses, and two of the leading businesses are S&P Global Ratings, which is the largest rating agency in the world, and S&P Dow Jones Indices. So we have already launched several crypto indices in the space. And there was Charles and I separately had conversations with different parts of our exco about how we as an organization need to be paying attention to and getting involved in the movement towards decentralized finance. And so that led to the creation of our team, the DeFi team. So we sit in a strategy function, and we have a remit to help the organization prepare to adapt and create a new generation of products and services that are fit for purpose in decentralized markets. So we're a small team, but we work with stakeholders across the organization to try to accomplish that goal.
I would have loved to have been a fly on the wall at the conversation where you pitched this to the CEO. What did you guys tell him to?
So they were actually separate conversations and many that culminated in the outcome of like, okay, we got to get involved. And our CEO actually introduced Charles and I to each other. So I come from a markets background. Charles comes from a tech and crypto background. And together, our CEO brought us together to drive this initiative.
But you don't just have a crypto background, right? I've heard that you're the most interesting man in the world, like the guy in the Corona commercials doing surgery. And
Yeah, so it's like I've been following the wind. So I'm living in Argentina right now. I was in China before, in Brazil before, in France originally. I did a few years of medicine. I hated it. So doctors were all either divorced and depressed, thinking of where they should go on holiday. And I say, maybe I should work in hotel management. I'll just leave on the holidays.
Just do the holiday part and skip the medicine part. It's perfect.
So I went for hotel management. I was in hotel management, then in China. And then I just come back to what I really, really liked, the one I was doing on the side, which was computer science. So I went to Argentina, where it's kind of common to start from scratch, even if you're 24 or 30. And I went for computer science. I started to work at S&P Global Market Intelligence. Then there were people internally, so I was automating everything. And somebody told me, what you're doing could be automated. I was like, I'm the one automating everybody. So could be automated with machine learning. So I started diving in machine learning, doing Kaggle competition, etc. I ended up being the head of cognitive automation at S&P Market Intelligence. So I had a team of 60 automation specialists, machine learning engineer, data scientists, etc. But I was doing internally as a crypto guy for a while. And, the type of guy that in 2018, everybody come and say, hey, see, I told you. But then speaking with part of the exco, the C-suites, and many people around in 2020, after the DeFi summer, there's been a switch, right? Like in November, December, everybody came back, was interested, wanted to know more. It seems this thing is not dead again, right? So like in general crypto and what is DeFi. So we had many sessions explaining everything. Then we had legacy chief index officer, which was Chuck, which was also looking at that and moved to a role to look at innovation, etc. So we were introduced, and we started thinking, okay, what can we do in the field? And is there a space for S&P? Because as you said, when you think crypto, nobody's really thinking S&P. So, but all the collapse we had in the last few months is all related to lack of risk management and transparency around risk, etc. So that's a place where there's actually huge demand for that. So yeah, that's what we're looking.
Yeah, I'm one of Voyager's top 30 creditors, so I can I can certainly speak to that personally, unfortunately. And so then, what role do you see S&P taking in the space? What kind of products are you creating?
Yeah.
How do we actually teach people to manage?
Right. So I think we've already launched, I would say, the first stage of in the ratings and the assessment business in the crypto space by integrating components of DeFi and digital assets into our existing ratings. So you can see that with crypto natives like Coinbase and Compound, the ratings we have for them. But you can also see that in non-crypto natives that have exposure to crypto that we also rate. So that could include El Salvador, that could include MicroStrategy, kind of, or other companies. So, and I think the next stage is the immediately adaptable is when we look at the financing of real-world assets on DeFi rails or tokenization of real-world assets, some of those structures will be utilizing or the opportunity to utilize securitization structures. And we have a lot of experience in kind of assessing the risk in securitization structures. So that's another kind of, I would say, the next area that we can focus on, where we can contribute to the evolution and maturation of the industry by bringing our expertise in assessing the risk in securitizations to this part of the DeFi market. In the long term, though, I think the real opportunity for us is to look at how do we take our historical expertise in credit analysis and off-chain analysis and combine it with a new set of on-chain data and analytics to create a holistic approach to risk in the DeFi ecosystem that brings together both the systemic risks in the system and the idiosyncratic risks in the system. We have a lot of experience in that in the off-chain world, and looking to develop those parameters and that expertise in the DeFi and digital asset world. And so that's what we see as a real opportunity for the firm in the longer term, to create this new generation of risk assessment products that will help not only TradFi clients onboard DeFi and crypto into their existing business models, but also further advance the maturation and the move away from over-collateralization in the DeFi space. So we think there's a real opportunity and need for that, and we are striving to be the ones who provide that.
You talked about sort of the systemic risk and lack of risk management, and we've seen sort of the collapse of these CeFi platforms left and right. But the story that nobody was really talking about is actually how well DeFi performed throughout this crash, right? As you said, they're over-collateralized, liquidations happened in an orderly manner, margin. And so, yes, we have the hacks and the exploits, but I think that there has been sort of underlying proof now that DeFi is superior to a lot of these other systems.
Yeah, but there's a different aspect, right? Like the problem with over-collateralization is a lack of capital efficiency. So if we really, really want to scale from there and have, big asset manager and pension fund get in, they probably won't go for something over-collateralized, right?
They don't want to put down $10 billion to take a $5 billion loan. Right?
Yeah. But plus, yes. But then there is also the kind of what we like to almost call the new DeFi, or sometimes was called DeFi 2.0, and you got the Maple, the Centrifuge, the TrueFi, the Goldfinch, the Clearpool, and all those others, which are all looking at under-collateralized, uncollateralized. Some are taking like X-Margin, or now called Credora risk assessment, kind of see, okay, what is the actual risk of this specific pool? And what we're really looking at as a second stage is, yes, to be able to look at on-chain and off-chain. We don't have on-chain capability right now. And be able to have maybe just, again, at the strategy level thinking, but there's huge demand for stablecoin risk. And then all around governance risk and liquidity pool risk. Then here you definitely need the on-chain aspect to then be able to actually have an overall protocol risk, which then can also be used as a benchmark. So that's all the aspect we're looking at, also combining with, okay, what would we need to actually be able to do that? But something really interesting right now is what all those protocols, which, as Chuck was mentioning, which are doing securitization in a way which is not that different to what our existing methodology are kind of looking at normally, except there is a repayment on DeFi rails. Because at the end of the day, the big question is, if you put your money here, what is the risk of not getting it back? Or what is the chance you get it back, right? So you could ask this for, if I put my money on DAI, if I put my money in this specific or uncollateralized pool, you don't really have a lot of visibility right now. I don't just say a specific protocol, but all of them, if you put your money there, you don't really fully know, most is not on-chain, right? Many are actually lending to lenders. How do you know the real risk that is behind? Well, if you want trillions to get in, you'll need to have this kind of visibility on what is actually behind. And that's exactly the way it's done in TradFi. You have rating agencies that give you an opinion on risk. And then when there is, for instance, something like what happened with Wintermute. It was a hack. We're not a tech shop, right? It's probably not, we will not find the exploit before the hacker or something like that. But the big question is, okay, now that there is this hack of 160 million, did the credit risk change? And if there was a possibility for people to just look at, okay, what S&P is saying, because the rating was that, are you changing it? Do you have a different outlook? It will just transform the overall field. And if you look for the HVB deal of Melker, the Huntington Valley Bank deal, there are some other that we're aware of that want to have longer duration and do something similar. But longer duration is complicated in DeFi because you need to defend the peg of DAI, etc. Now, if you start to have a secondary market for those loans, then even protocol like Melker would be able to be a bit more relaxed, knowing that they could sell maybe at a discount, but depending because you need a rating here to kind of have an idea of how risky is the specific loan they did. But then it just creates the possibility for a secondary market of those loans, which then enable Melker and some others to just scale.
And creates a much more efficient market.
Yeah, I think the Wintermute is an interesting example because what we've seen, when you look at the events in the beginning part of 2022 with Terra Luna and then 3AC and Celsius, that really exemplifies the combination of idiosyncratic and systemic risks. And so Wintermute is another example where we are well versed in our traditional business of looking at both credit fundamental risk and operating risk. And so how do you think about operating risk in a crypto and DeFi context? And so perhaps the smart contract audit is a piece of the operating risk that is unique to DeFi that needs to be integrated appropriately into our approach to risk assessment. So it's not like you're necessarily starting from an entirely new concept, but you're applying it in a way that is different and fit for purpose for this ecosystem.
You have the first few chapters of the book, but you definitely need to finish it. I mean, that makes perfect sense and seems like a monumental challenge. I want to focus on something you both mentioned, which is obviously securitizing these assets. I think there's an idea in the crypto space, sort of pie in the sky, that we tokenize everything, right? Tokenize everything, it improves everything. Your house is attached to an NFT, your title, your mortgage, every stock, no more clearing, right? We just exchange one to one. Is that the end goal? Do you see it as a replacement for the systems? Or are you looking to build effectively, a parallel financial system for people who maybe don't have access to that?
Well, I would say that Charles and I actually agree in the pie in the sky that we think the tokenization of everything is going to happen. But who can predict the exact twists and turns of the pathway to that? But in the meantime, we want to make sure that our organization is positioned to provide the services and products that are needed to shed light on risks in the industry and allow stakeholders to make informed decisions and to help facilitate kind of better price discovery kind of in the ecosystem. So in the long run, we think tokenization of everything kind of will happen. But in the range from purely centralized to purely decentralized, my personal opinion is that we're still going to end up in some blended space. It's not the maximalists on both sides.
How dare you admit that there's not just pure centralization? That's literally one of my favorite talking points and you can't be purely decentralized without starting centralized anyways and moving in that direction.
Right. And so what I think we will strive to do is ensure that as the landscape evolves and innovates and matures, making sure that we are keeping pace with it and evolving our products and services and capabilities alongside it. So if it ends up in kind of the far extreme towards decentralization, we want to be positioned for that. And if it ends up right in the middle of a well-balanced blend between centralized and decentralized, then we want to be positioned for that too.
And I would imagine the further down the spectrum it lands, the more of the big companies will be left behind and the institutions that currently exist. I mean, now we are obviously your S&P, we're talking about NASDAQ doing custody, we're talking about Fidelity and Citadel partnering for exchanges, BlackRock. The names are here, right? And you can see who intends not to get left behind.
So what's really interesting to us is since the creation of our team, 4 or 5 months ago, we've been out speaking to stakeholders across the world from all different areas. So TradFi, crypto native, buy side, sell side, regulators, policymakers, et cetera, et cetera. And what's been really interesting to us is that there's a wide range of positioning from our TradFi clients. Some that are very advanced, I would say a small handful that are kind of very advanced. And then even maybe a smaller handful that have dedicated something kind of in alignment with what we've done, like a very small team to start focusing on it and figuring out kind of how to carry our strategy forward. But then the vast majority is more like, okay, we need to do something with this. Let's pull together a task force, a working group where everybody still has a full daytime job. But they add on this, on top of it. And I think that's going to change in the next period, whether that's 1 quarter, 2 quarters, 4 quarters. But I think it's going to start changing pretty quickly as the big players have been investing human and financial capital to build capabilities. And now that we're on the verge, I think, of getting some stablecoin legislation in the US, I think that will prove to be a turning point that first of all, allows the players that have already invested in their capabilities to start executing and really scale their execution, but will also incentivize and kind of galvanize action for all the other players that are looking at it but haven't really taken kind of a lot of concrete steps to.
And they'll just actually be able to deploy and get it past their risk managers, which I thank you for a lot. But what's interesting is you just described sort of 3 levels of institutional interest with all the people you're meeting with. There wasn't the 4th level, which was the only one we heard in 2017-18, which is this crap is going to zero. We want nothing to do with it.
I was going to say that we're so far away from 2018, right? 2018, trading desks were closed. Everybody was going away. And now, if you don't look at the price, it really doesn't look like a bear market. There's a lot of people at mainnet. All the institutions are investing and doing everything we just mentioned. It doesn't, like, you don't look at the price, it's not a bear market. Like, everybody continue to invest and create. There's more and more developer, more and more hiring in big institutions compared to 2018 where everybody was closing shop, except some DeFi products.
Yeah, I would have argued at institutions in 2018, if you were the guy who dared to walk into a meeting and say the word Bitcoin, you probably had the risk of being fired. And now if you're working there and you don't have an opinion, you're probably at the risk of being fired.
Yeah, it's really interesting. Like also in my personal life, so I've spent my career on Wall Street, and my peer group typically, if I go back a year and you told them you're looking at crypto, that was like, that's all a scam. That's just like, are you crazy? And today, now, they'll be somewhere to either be staying quiet or saying, yeah, it's interesting, I'm going to start looking into this. So I can see in my own personal life like a dramatic change in my peer group from the TradFi peer group just in the last year.
I'll take it. I'll take any interest, all hands on deck that we can get. You talked about the idea that we might have some hopefully sensible stablecoin regulation coming down the pipe from the United States. Are you concerned that there will be less sensible regulation in other areas of the market that might stifle what you're building or impact the market negatively?
Yeah, so I think I would call it policy formation more broadly, because it's going to be a combination of regulatory actions and legislative actions. And of course, whenever you're charting a new course and creating a new framework, there's always going to be the risk of missteps, or what I would characterize really as unintended consequences. And so regulatory formation and legislation formation will be kind of full of pitfalls of unintended consequences. And so when you look at the legislation that I think may be coming soon on stablecoins, it's really targeted fiat-backed, US dollar fiat-backed stablecoins. And I suspect...
Fully or over collateralized.
Right.
Yeah.
And that will be like the starting point. And then as it starts to migrate out into kind of maybe other forms of stablecoins or tokenized deposits, or looking at DeFi, which could take years to get to, there's going to be a lot of room for kind of legislation or regulation that kind of isn't exactly what is the best for the market. But I do think that as the market matures and as these big traditional players get more involved, I think that's going to help the policy formation cycle. So I'm hopeful that we can minimize the number of unintended consequences as we go through this period in time. And when you look at a piece of legislation that's been proposed from Senators Loomis and Gillibrand, that's a pretty wide-reaching, and my suspicion is that we're going to get this narrow stablecoin focus in the short term, and then looking at the broader ecosystem will probably get unbundled and broken into kind of more component parts. And I think that'll be good for the industry and for stakeholders, for all stakeholders.
I think that piece of proposed legislation was the most encouraging thing that we've seen. Pragmatic, sensible, and obviously, as you said, most of it will probably never even be addressed, right? But the very idea that that's sitting on everyone's desk, I think, is extremely encouraging.
Yeah, and it's also, we were joking when we were in Europe that, but people think bipartisanship is dead in the US, but here in this space, bipartisanship is really alive, and you have a lot of support. You have detractors and support on both sides of the aisle, and I think that's also a function of the realization of how important this is and how transformational it can be. And the more that policymakers kind of get in tune with what the promise of this is, I think you'll see kind of the story getting more complex and nuanced, which will, I think, lead to better policymaking.
I hope so. You were a bank regulator at the Fed recently, and sort of went under the radar. There was a proposal or statement that banks who want to custody crypto should view it as a liability rather than an asset. That blew my mind. You would have to have a cash equivalent in the bank to be able to custody crypto assets. I mean, to me, that would be as damaging as anything. I mean, State Street and BNY Mellon are not going to do that.
Well, I think we should expect to see a number of proposals that, upon further inspection, might not be optimal for the totality of the economy and for the ecosystem.
Yeah, I don't think they'll have it.
And in policymakers, you think about their challenge, right? They're trying to balance systemic stability with consumer protection and providing for financial innovation. So that's a tough balance to find. And I think what I've seen in kind of discussions and following the policy landscape is that last piece of financial innovation is getting more attention. And it's really easy and prudent to focus on consumer protection and systemic stability. But as the importance of financial innovation gets elevated, I think that will also kind of help reducing the potential for unintended consequences in the policy formation.
Well, let's live in a fantastic world where we get all the regulation and sensible policy that we want. What would be the most optimistic, ideal version of what S&P could build within that framework? In 10 years, where do you see the role in what you've built in this market?
10 years is pretty hard because DeFi is just 2 years old.
We all know that's dog years. I mean, in 70 years, where do you see?
But no, the goal is really to bring transparency, right? Like, one of the things we've been asked several times is, do you think that if you were in the field when Celsius and Voyager and everything happened, would you have helped avoid that? And we're not really saying that, but we would have broad transparency. So then you decide which risk you want to take. And yesterday at the opening panel of Mainnet, one of the speakers was saying that, people were saying, hey, there's 99% yield here. I don't care about the risk. I'm just taking it. So it might not have changed everything, but at least you would have known.
I wholeheartedly disagree with that.
Yeah.
If someone had said they just offered a $700 million uncollateralized loan to somebody, I think at least 25 to 30% of the people would have said, I'm going to take my money out. Don't want to be a part of that.
Well, that's the goal, right? I'm trying to say we're not pretending that we'll transform everything. Like my opinion, my own, I think it could, because that's exactly what is lacking. Like if you put your money, I'm, really interested in the field in general, crypto native. I have no idea of the risk when I put my money in a specific pool. It's just not something you can assess yourself. You don't have the information, especially for uncollateralized pool or even CeFi, which was a full black box.
And you thought it was a bank?
I didn't use them because
not
I'm
you,
more like on
but
the DeFi
your
side.
average person.
Yeah.
That was the difference here between. Listen, if you invested in ICOs and lost all of your money, at least you were crypto native. Now we're talking about your average person who deposited into something that they thought was a bank, that they thought was FDIC insured, and lost everything.
And it was all around TikTok, all around YouTube. It was mentioned as something safe. Yeah. That's why there is a need. And it's interesting because the field is really trying to self-regulate and basically continuously finding solution. And there are actors within the DeFi space which are looking at risk in general, right? In different way. You got Gauntlet in their own way. You got Certic is looking, not just at they're doing some monitoring also. Coinmetrics is looking at risk. Of course, Credora, Xmargin, the change name. Membrane is kind of in a way doing this now. So it's happening. Will we be part of the mix from this TriFi angle? Well, that's definitely something we want to, because the issue, and Spectral also I didn't mention, most are looking just on chain. But again, if we look at all the issue we had, this would not have helped, for instance, with what we had. So,
or you would have had less people affected because they would have known the risk.
But it was on chain, right? So basically nobody could flag it. Many were already there. So you need something which is both on chain and off chain, looking not just at risk of liquidation exercise. It's a complex equation, but you need to look at the actual credit risk itself, not just what is the risk of exploit, etc. And right now nobody is really doing that.
Right. So would it be a simple
what we want to do.
A rating system comparable to what you have elsewhere?
Yeah. So we don't know yet. I don't know that it will be a rating. Rating is something pretty specific. And it may be more akin to like a cyber risk assessment or an ESG risk assessment. So that's to be determined. But as Charles was saying, the goal here is to really shine a light on the risks that exist so investors can make informed decisions on what kind of risks they want to take, and that so markets can price risk appropriately. And I think that's the role we help play in traditional markets, and I think that's the role that we can help play in DeFi and crypto markets by kind of shining the light on where the risks are, both idiosyncratic and systemic. It will facilitate price discovery and appropriate pricing for the risks that are there. So I think that'll be hugely beneficial for the ecosystem, and also hugely beneficial in getting and unlocking what we believe will be trillions of dollars of TradFi assets into the ecosystem.
Yeah, it's my feeling that the pensions and the endowments are all just waiting for an excuse.
They
just need to be able to do it in a risk-managed manner, right?
When we spoke with several protocols, they are speaking with pension funds, they are speaking with big asset manager, and what is being said to them is we need two things. We need visibility on risk. That's definitely where we can help. And we need regulation. But even when we speak with them and we explain what we're doing, first, many are surprised because, you're looking at that field. And they're also saying on the asset management side that if there was something with an actual rating or risk assessment, it would even transform internally the conversation for them on the possibility to do things. Because now you can say, well, there is, a third party that that we work with that gives that kind of opinion, even internally change everything. And almost on the DeFi side too. And I was surprised when several people at Melker, core units, told us that we would bring decentralization in the field from like ZDAO, right, the decentralization. But it makes sense because right now, who is doing the risk assessment? Well, they got a team doing it, and then you got the one asking for money, which is saying, hey, send me money, I'm super safe.
Yeah.
So a third party in the middle is kind of a way of decentralization. It's not me saying it's
ironic. Yeah. If we were supposed to eliminate all of the trusted third parties, but you actually need them. And I've heard that sort of narrative repeated multiple times in interviews that I've been doing of late. It really is an interesting take. And you talked about sort of the self-regulation in the space, but even some of the names that you threw out, I mean, every one of these hacks and exploits that we've seen has been audited by multiple companies. These are audited smart contracts that are still getting hacked and exploited. So even from internally, the best risk assessment we can do, they generally have ended up failing. None of these exploits have happened to something that was unaudited.
But the question we don't have an answer to is when there is an exploit, and I don't think anybody can, there is a white hat that can help, but at the end of the day, there is an exploit, it will happen. Not everybody will be able to find it, etc.
Sure.
Now, once it happened, the answer we don't have is how does it change the credit risk from this specific borrower? Right. That's really missing. And this could be calculated, but it's not something that really exists. So that's exactly where we want to help and push the field to maturity and have those sensors. So
that's when, a clearing hole.
Yeah.
So you talk about systemic and idiosyncratic risk and understanding them. It's funny because a lot of people viewed Bitcoin certainly, but the crypto space in general as an asset class that offered idiosyncratic risk to your portfolio. Have you been surprised at all at how it's been trading in lockstep with equities during this bear market?
Yeah, yes. I don't think the correlation you've seen with digital assets or crypto or Bitcoin in particular, with equities or tech stocks in particular, really makes sense to me. I understand why it's happening. But I think in the long term, that correlation is going to break down.
It will. It always did. It was uncorrelated, so it's.
Yeah,
I guess it's one of those when in a bear market everything goes to one.
And as the TradFi players come in, that may also kind of provide a pathway to kind of an extended period of high correlations. But the fundamental characteristics and the efficiency and improvement in cost of capital and the improvement that DeFi and crypto assets and digital assets bring to the ecosystem will stand on their own. And so I do fully expect the correlation to break down. It's hard to say when that's going to happen.
That's kind of one of those things where you get what you wish for, and everybody wanted institutions here, but institutions don't come in to buy Bitcoin to hedge against inflation. They come in because it's another asset in their portfolio that they can long or short, and it starts to trade like everything else, and it's liquid 24/7.
Yeah, and it will also be interesting to see as more TradFi players come into the space. Do they focus on kind of the specific integrating Bitcoin or ETH or other kind of digital assets into their portfolio construction? Or do they actually look at the abilities of financial engineering that this space offers? And I suspect it will probably be one leads to the other, but I think the real opportunity, yes, I think there will be portfolio construction that goes across tokenized traditional and crypto native assets. I think that will eventually happen. But I think the real opportunity set in the space is kind of from the market kind of functioning and financial engineering perspective.
So we go from 60-40 to 60-35-5 or something like that first, but then they realize that they can actually earn yield in this space in a secure manner, and that's really the unlock and the exciting part.
That's what I think.
It's all about yield, right? I mean, at the end of the day, that's what people have gone to crypto for. Yeah. I guess now you can get 4% on a one-year treasury. But
and that's where the staking of Ethereum is kind of making many people kind of reflect on how can the bond market is getting complicated. The 50-40 model, since I think Bitcoin Miami in every conference we've been at many, is being mentioned. It's kind of not really relevant anymore. It's going to evolve. Where is the place of staking here? Because there is an actual digital asset, and then there is something like Ethereum, which should be deflationary when there is enough movement there. Deflationary asset that gives a yield, that's really new. Now, well, the risk around that is a totally different question. But we think that the portfolio management, the portfolio configuration will be like resold 100%. Yeah.
I mean, I've seen that argument made about the merge and the move to proof of stake countless times. Now you have effectively a benchmark yield within the crypto space, so everyone else can now say, listen, if Ethereum's 7%, we're doing, Ethereum plus 1 to get you to 8%. Is that worth the risk? I mean, is that sort of what you would be looking at?
Yeah. I think one of the interesting conversations we've had internally is how do you think about the risk-free rate in a crypto context? So in traditional markets, the concept of a risk-free rate and discounting of cash flows and valuations that flow from that are all well understood and documented. But in the case of DeFi and digital assets and crypto, is the risk-free rate kind of the same, or could there be multiple risk-free rates? And then how does that translate into the valuation and within and across the ecosystem? So that's I don't have an answer to that.
That pretty much is the question,
But
right?
that's the question.
Is Ethereum now a risk-free rate?
Right.
No. But it's probably the closest that
Or
we've
a
come
proxy
in
for-
stake. It's probably the closest that we've come. And then, of course, the argument is, sure, you can get 7% on your ETH, but what if ETH goes down 70%? Right.
Yeah, but then, well, I live in Argentina right now, so you have a different perspective when you got 100% inflation and the currency is being devalued constantly. So it's always, you compare to what, right? So right now in the US, you have a very strong currency. You do have inflation, but there is this concept outside of the US on, what is really the alternative you have compared to the option in TradFi, and what is risk-free in some country can vary also. And this is global. This is something like even if from the security of it, right? If you stack in ETH and you're in Ukraine and what happened, you can just move somewhere else and you still have your ETH. Now maybe you had something seen as risk-free in a bank account. Can you still access it? Is it really risk-free? There's a lot of different angle in a very changing world to look at that.
Yeah, it's a lot easier to talk about this asset class in the United States for institutions who just view it as another asset rather than something that can save your life. I mean, everyone's heard the stories, of people crossing the border and being allowed to keep $50 when they leave. If you have your seed phrase in your mind, obviously, then they can't steal your assets. I think that's huge. You live in Argentina. I've actually had a guest on previously who said that he would basically, when he would get cash, he would take it, convert it to United States dollars, and then put it in the safety deposit box in his bank rather than depositing it into the bank. So clearly there's a real problem in Argentina.
It's not him, it's everybody. I'm not speaking about me.
Like you use the bank as a safety security, as a safety deposit box rather than as a savings account.
Most will have it at home because banks have been taking everything from people several times in Argentina, and it's not a full guarantee to have safe in a bank. So there's crazy amount of cash within like the home of the people, just because if you save in pesos this year, you already lost half of the value of your money.
Right.
So everybody that I've seen that I know, the first thing you do at the beginning of the month, you receive your salary, you check how much you need to spend, and all the rest is moving to the gold of the country, which is the dollar.
Right.
But now, so there is a full, it's called like a black market for that because you cannot access the dollar directly with the normal exchange. And this black market has been evolving, and now they offer also a lot of different stable coin for a fee. And people are moving to that. And it's also a way, it's a really complex question, Argentina. I love Argentina. But because of many restrictions, there's many people that actually work in also a type of black market. So they'll either get paid before in Uruguay in dollar, and they would go in a boat and bring back the money, then change it as 3 times the value on the black market. Or now they can just do it with crypto, and they get paid in crypto. Of course, it's illegal from an Argentinian law standpoint because they're not paying tax, etc. But it's like on the developers and that kind of thing, it's very common.
It looked like it was going to be legal, and then the IMF came in, obviously, and said to Argentina, maybe not. But that's a conversation, I guess, for a different podcast. But I think Bitcoiners love the idea that people in countries with hyperinflating economies are going to buy Bitcoin to hedge. But I think you actually just identified the truth, and people don't want to hear it, is that for most people, stable coins, which is access to the dollars that you can't get, is actually what they're converting into, and that those stable coins are much easier to transact with.
The average people now will have access in Argentina. Actually, it's paradoxal. It's because of the context. You have a way higher adoption of this technology by a broad range of people, just because, the place where you would normally go to get your edge against inflation now also offer you crypto. Very few are actually using protocol, but they would use wallet. And actual wallet, not centralized exchange many times, where you'll just deposit and then you can send, etc. But very few are actually using the yield. But if you think of it, like in many of those countries, not just Argentina, you cannot many times get a yield which is safe and above inflation. And if you think of a yield in dollar, it's going to be very, very low. But now, you have those stablecoin, you got those protocol, and you don't need to be in any country to really be able to interact with them. So, and that's something, again, that is really not seen a different way from the US. But I've been seen different podcasts, and I agree with them. Some country might lose their currency, but not because of Bitcoin. So many of the rhetoric of Bitcoin are actually true, but might happen with stablecoin. Yeah. That's my opinion on my own.
I hate to admit, but that's become my opinion as well. That's not what I would have thought 3 or 4 years ago. So just circling back to S&P, of course, you guys obviously are in the infancy of your team. You said it's only been a few months. If you had to guess, at what point do we start actually seeing ratings and reports coming to fruition that are usable for institutions and the general public?
Well, I would say we've already started that with the rating of compound prime and treasury. I think we're going to see more ratings coming out from the DeFi and crypto landscape that harness our existing infrastructure around risk assessments. So it could be corporate risk assessment, sovereign risk assessments, structured products risk assessment, and I think you're going to see kind of more of that rolling out in the near term. Kind of building that longer stage risk assessment framework that Charles and I were talking about, it's hard to say kind of what that time frame is going to look like.
You never even know what the space is going to look like.
Because we don't know
assessing.
exactly. Yeah, and there's still a lot of what we've been doing the information gathering, getting connected with kind of on-chain kind of players to start really figuring out what are the needs that crypto native and non-crypto native players would need for risk assessment? What are the data points that we would need to create the IP that enables the risk assessment capability? And then how do we go about kind of building that and a go-to-market? So that's a lot of steps still to come. But in the shorter term, I think you're going to see a continued focus on kind of the harnessing those existing capabilities to come up with ratings that are fit for purpose for debt issuance.
You mentioned reports. We have a few reports that were done by the research lab.
Yeah, so we also created maybe about a year and a half ago a research lab in the organization that focuses on digital assets and crypto. So S&P Global Ratings has about 1,500 or so credit analysts. So it's a deep pool of credit expertise. And the research lab pulls from across not only the whole ratings franchise, but also across the whole organization to put out thought leadership and undertake studies to help inform not only ourselves, but help inform our clients and kind of broader set of stakeholders on the ecosystem. So
yeah, you're clearly the people to do it. Everybody else would have to reinvent the wheel, and you guys have already been doing it. So that makes perfect sense. Well, I think we all agree that there's a institutional wall of money just waiting. So if you guys can help us open those floodgates, we really appreciate it. And we'll be cheering for everything you guys are doing. Thank you so much.
Thank you.
Thanks for having us.
Of course.